Now let's discuss the demand side. What moves demand? Well, oil usage is very seasonal. In the summer, people go on vacation and they drive a lot more, especially in the summer. In the winter, people have to heat their homes. That's a big use of oil. This causes a stocking and destocking cycle for oil. Refiners build up inventories of gasoline in the spring in order to have the gasoline available when people start driving a lot. And then they build up supply of heating oil in the fall. So they have that on hand too. So this not only causes a change in the price of oil in general, it causes changes in the relative prices of oil because the light sweet crudes are better for refining into gasoline. Heavy sour crudes can be used to make heating oil. So naturally, any disruptions to the usual seasonal patterns will cause a disruption to the usual pattern of oil consumption. For example, unusually warm weather can cut into demand for oil in the winter, while unusually hot weather in the summer increases demand for air conditioning, which increases demand for electricity, which increases demand for oil to supply electric generators. So weather reports are required reading for the aspiring oil trader. Oil demand also varies with economic growth. When the economy is booming, industry uses more energy to produce more goods. Railroads, trucks, and ships use more oil to move these goods, and people tend to drive more. Recessions, however, it all goes into reverse and oil usage falls. You can see in this graph how oil tends to use. This graph shows the year-on-year increase, year-on-year change in oil prices, the line, and the shaded areas are the periods of recession. You can see how oil use tends to fall during recessions, the gray areas, and it tends to increase during expansions, the white areas. This is why oil prices respond to indicators of overall economic conditions, such as the GDP figures, the purchasing managers indices, consumer sentiment, retail sales, etc. Similarly, economic developments caused a large increase in demand for oil over time because people with higher income and a higher standard of living tend to use more energy up to a point. For example, China makes around 24 million cars and trucks a year. This is about 5 times what it produced 10 years ago, and 20 or 30 years ago, they made almost nothing. China makes about double the vehicles that the US makes. So obviously there's been a huge increase in demand for gasoline in China to run all these cars. That's an example of how the improvement in living standards and rise in general development increases demand for energy. On the other hand, it's a very interesting point, which is hard to quantify. Technology is starting to make inroads into oil demand in the developed countries. For example, the most obvious one is using solar power instead of oil to generate electricity. But also, internet shopping has reduced the amount of driving people do. Even things like Netflix reduce the amount of driving people do to go out to the movies. So while technological progress in developing countries often means greater use of energy and more demand for oil, in developed countries, it can have the opposite effect. So here we've got a table that shows the major oil-consuming countries. Note that the US, Europe, and China account for 48% of world oil use, which is why the oil market is particularly sensitive to indicators of growth in these 3 countries or regions. Adding Japan on, it's half the world's oil. Russia, Brazil, and Saudi Arabia are large consumers of oil, but they're also large producers of oil. So their activity doesn't make such a big difference unless their domestic consumption gets to be so big that they have to divert oil away from exports to domestic use. Now, overall, about the oil prices, what I should say is that they are mean reverting over time. although it takes some time. What they say in the oil business is high prices cure high prices and low prices cure low prices. What that means is when prices rise to reach a certain level, supply increases and demand decreases. Because, you know, if prices are that high, it becomes more economic to develop certain wells. And when prices are that high, people just don't drive as much. So supply increases, demand decreases, and the price comes back down. On the other hand, when prices fall, oil producers pump less oil, and because they don't want to sell it at that price, and consumers start to use more oil. They drive more, and that starts to push prices back up. So high prices cure high prices, and low prices cure low prices. Now, how do we judge the supply-demand balance in oil? It's really hard to see supply on a up-to-date basis. It's really hard, almost impossible, to judge demand on an up-to-date basis. But you can see the balance between the two by looking at the change in inventories. If you think of inventories, the inventory of oil, the supply, in effect, you've got, let's say, the world supply of oil is a big oil tank. In effect, the supply of oil goes in the top of the tank, and that's the supply. The demand for oil, they pull oil out of the bottom of the tank. That's demand. You can't judge, it's very hard to judge the supply coming from all over the world. You can't get accurate, up-to-date data on that on a timely basis. You can't necessarily judge the demand either, but you can measure the oil in the tank. So if the amount of oil in the tank rises, then supply is exceeding demand. And on the other hand, if the amount of oil in the tank is falling, then demand exceeds supply. This is why the weekly inventory figures from the American Petroleum Institute, the API, and the US Department of Energy, the Energy Information Agency, the EIA, are very closely watched. As the table I showed before showed, this here we've got the US accounts for around 20% of world oil consumption. So its supply and demand for oil is really the single most important factor in determining the price. Now, since these, the API report and the EIA report are the most important high-frequency news to affect the oil market, I'm going to spend some time discussing them and the difference between the two reports. First, the weekly API report. This is the American Petroleum Institute, a national trade association for companies that produce, refine, or distribute oil and oil products. The API produces a weekly statistical bulletin, which reports on oil production and the production of the 5 most important petroleum products. They account for more than 80% of total refinery production. It also includes information on inventories. They publish it every Tuesday afternoon, and it refers to the weekend of the previous Friday. One key point, the report's available by subscription only, so the numbers aren't widely distributed to the general public. But everybody in the oil business subscribes, so they do move markets. Now, this is a copy of the report. The circled figure down below, the change in crude oil stocks, is the most important number. Secondly, here's the Department of Energy report. This is the U.S. Department of Energy, a cabinet-level office. Within the Department of Energy, they have the Energy Information Administration, their statistical and analytical agency. They publish the EIA Weekly Petroleum Status Report. This gives information about the supply of oil, both imported and domestic, and the level of inventories of crude oil and refined products. This is published every Wednesday, the day after the API report, but it covers the same time period as the API. Now, this is the EIA report for the same week that I showed you the API report. And again, here we look, the main thing is the change in crude oil inventories that everybody looks at. So in both reports, they're focused on the change in inventories from the previous week. A negative figure shows a drawdown in inventories, which suggests that demand exceeds supply. As a result, prices often move higher. Yesterday, the API announced a 6.2 million barrel drawdown in inventories, much bigger than expected. Oil prices were up 2%. On the other hand, an increase in inventories would tend to push prices lower. Notice here that it also says the Strategic Petroleum Reserve, which is the U.S. government holdings of oil, but people just ignore that. It has nothing to do with the underlying demand. So in this report, the EIA said 7.4 million barrels. The API said 7.2 million. It's pretty close together, pretty close, but not the same. Why aren't the two the same? They both use the same definitions and cover the same time period. The API comes out, as I said, a day earlier, but it only covers its 550 members and other companies who agree to report to it anyway. On the other hand, by law, all oil companies have to report their information to the EIA. So the API reports a day earlier, but the EIA report is, in theory at least, more complete. There are other differences. Some of the differences also arise because the API sometimes rejects data if they think it might be accurate. Also, the two organizations have different statistical methodologies for estimating data from firms that don't respond. In any event, I think the market reacts more to the EIA data because A, it's perceived as being more accurate, and B, since it's publicly available, many security firms produce forecasts for it, and that produces a market consensus to judge the figures against. Although, of course, traders' views on the market consensus may change Tuesday afternoon after they see the API figure. The EIA data also includes initial estimates for U.S. oil production. More accurate figures are available sometime later when the monthly numbers come out. This is very important. I'll discuss it later. Now, the API and EIA figures usually match in direction, but not necessarily in the magnitude. They're the same direction about 86, and from 2015 until March, they were the same direction 86% of the time. So once every 7 weeks, more or less, they were different. But for magnitude, the two differed by over 1 million barrels 60% of the time, and by over 3 million barrels 24% of the time. So you can't exactly, so there can be a big difference there. Now, how do these figures affect the oil market? Here we can see the change in the EIA crude inventories. That's the black line reversed, and the blue line reversed versus the change in the WTI price. As you can see, when inventories are increasing, WTI prices tend to decline, and vice versa. That's because rising inventories show supply exceeding demand. The seasonal nature of the market means that inventories have to be evaluated in relation to the average inventories for that time of year. So usually investors compare the current level of inventories to the average for that week for the last 5 years or so. And that's what I've got a graph of here, where the orange part is the normal range for the week over the previous 5 years, and the blue line is current inventories. You can see how inventories are wildly higher than would be normal, and they have been for the last 1.5 years or so.